Welcome to Pricewaterhouse Mexico discussion on the tax reform of 2016. This module is specifically relating to BEPS and the country-by-country reporting obligations under the new law. For this purpose, my name is Fred Barrett. I'm a partner in the transfer pricing area, and I'm accompanied by Sergio Perez Cruz, who is also a partner in transfer pricing and dispute resolution. We're going to cover BEPS primarily to be a background to the new legislation that's the country-by-country reporting and the 3 reports that are required under the Mexican law. We'll start as an additional background talking a little bit about BEPS and its background and how this had an impact on this new legislation in Mexico. For this purpose, I'll invite Sergio to give that initial discussion of BEPS.
Thank you very much, Fred. Thank you for being with us today. What I would like to do is to make a very quick summary of what the BEPS initiative was. As you may recall, the Base Erosion and Profit Shifting Project is a project initiated by the OECD almost 2 years ago. This project started as an academic project and then evolved into a BEPS action plan with 15 specific actions that were devoted to prevent base erosion and to prevent profit shifting in several countries around the world. This project has been successfully finished a few weeks ago. And with that in mind, we would like to go through 4 or 5 of the different BEPS actions that we find more interesting for transfer pricing purposes, and that will also give us a framework to work with what Fred is going to explain us in a few minutes.
Just one quick question, Sergio. I know that you were part of the G20 group. How active has Mexico been in forming and shaping these new rules relating to BEPS?
Very active. In fact, the project was launched in Los Cabos G20 meeting, and from the very beginning, Mexico made a commitment to participate very actively in this, not only as a regular OECD attendee. We have to remember that Mexico and Chile so far are the only 2 Latin American countries that belong to the OECD. At this point in time, Costa Rica has also requested their accession, and Colombia to the OECD, but so far it's only Mexico and Chile. With that, Mexico has always been perceived as the leader or as the head in Latin America region regarding OECD projects. In this case, Mexico and the Mexican delegates of the OECD were very committed to the project and participated in various focus groups for this BEPS project.
So we have you to thank for all of these new provisions.
Yes, probably a part of at least.
Very good.
Thank you, Fred. As I said, this project has been very, very successful in achieving its goals on time. The project had a very ambitious agenda with several dates and deadlines and deliverables agreed among countries. This project started, as I said, in 2013, and it was finished in October 8, just maybe 20 days ago. The main focus of the project was to enhance transparency, enhance tax cooperation, tax compliance, tax communication among tax authorities, and also to design control mechanisms and relevant information, tax filings for the tax authorities to have, and to be able to identify risk for base erosion and profit shifting. So if we see the actions that we have, that we want to analyze today, we can go very quickly through action number 2. Action number 2 was named Neutralize the Effects of Hybrid Instruments. This kind of instruments, specifically the financial instruments or financial entities that could perform hybrid operations, are very important because in several countries, sometimes you are allowed to take a deduction, but this deduction does not have a mirror effect in the other country. So you have the deduction in one place and you do not have the accumulation or the taxable income in the other place. So the OECD invited countries to analyze these kind of issues and to design rules to prevent this kind of behaviors from multinational companies specifically. Another important action is action number 4, and this action was aimed to study and to analyze what they consider, what the OECD considered that was the base eroding payments. These kind of payments as interest, royalties, management fees, head office expenses, has been perceived as one of the main sources of base erosion in multinational companies. So the OECD invites or designs some recommendations for multinational companies to address these kind of issues.
Sergio, as you know, the management fees has been a controversial issue globally, especially relating to Mexico. There's been a lot of focus on that area. can we expect that these final guidelines relating to Action 4 will actually give some relief in Mexico relating to management fees and similar services?
Well, yes, we would hope that this triggers a change in our legislation because, as you mentioned, in Mexico, prorated expenses are strictly forbidden. In this sense, management fees and head office expenses have been analyzed from a benefit perspective. So the OECD has highlighted the fact that it is important to see that companies that receive this kind of charges from the main offices should also receive a benefit. So as long as we are able to demonstrate that there is a direct benefit for companies, which is most of the times there is, I think that regulations should state that these kind of payments are deductible.
Okay.
For Action 7, that's the following action that we would like to quickly touch. It's the permanent establishment avoidance. As we all know, permanent establishment is a figure designed to address the problems between residence and source for the taxation of income. So in this sense, Action 7 invites countries to design or to review the rules for attributing income to permanent establishment. And even before this attribution of income, the invitation is to make a very good analysis on what are the main permanent establishment possibilities in the country. In this sense, Article 2 of the Mexican income tax law contains all the conditions for a permanent establishment to exist. So the OECD invites the countries to review the commissionary model and also the fixed place of business model.
So in this case, Sergio, sorry to interrupt, there's nothing right this second, but we can expect action relating to a redefinition of PE?
Yes, at least we can expect a review of this definition and probably a change in the Model Tax Convention in the near future.
Okay.
And finally, before we jump into the action that Fred is going to talk us about, I think that one of the most important parts for transfer pricing practitioners was the analysis of actions 8, 9, and 10. These three actions were combined and were very interrelated with them, so we would analyze them as a whole. In general terms, they say that this project should focus in making the results of transfer pricing to be in conjunction with the value creation. That is the most important part I find for transfer pricing from the OECD project. They have to, the results of transfer pricing analysis have to reflect adequately where the value of a transaction is created. And in that sense, there are several modifications to some of the transfer pricing guidelines chapters that we will expect to see in the near future to take place.
Before you move on the one of the interesting things in the 8, 9, 10 area is risks, and it seems like creation of value should be in line with what we've been doing in the past. Maybe some people haven't defined where that value has been created in enough detail, but the risk area, it seems like the focus is more on who is, not just what companies are taking the risk, but who are the persons that are making the decisions to undertake those risks. So that could be a somewhat of a shift. I don't know if you have a similar perspective.
Yes, exactly. As you say, it's going to be very, very interesting to see how this evolves, because usually risk was analyzed from a coverage perspective. This was a very common assumption, but now they are saying, the OECD is stating that it is important when we analyze risk to see who is able or who has the ability to control the risk. That is very important, because decision takers are usually very related to the level of risk that the company has in its operations. So it's important for us to analyze where the risk is and who takes the decisions that could affect that risk in order to make a proper functional analysis, asset analysis, and risk analysis in our transfer pricing documentation.
Great.
As a general summary, what we can see in this project that was presented in October 2nd in a webcast and also in October 8th in Lima, Peru, to the G20 ministers, we will see a consistency in the system as a recommendation. We will see that the recommendation invites countries to have more tax transparency, more tax communication, more exchange of information via the existing double tax convention or the EOI agreements, and also recommends to impose some deduction limitations and also some changes to the model tax convention that is now in place. What this project says in general terms is that the transfer pricing aspect is very important, and also that the risk and capital should be analyzed. And with all this small and very, very fast summary, I would like to see, or I would like to invite Fred to comment us on the Action 13, because I think that's a place where we can see the actions becoming a reality.
Thank you, Sergio. So Action 13, as we know, we call it the country by country, but it's really more than that. It's actually involving 3 different reports. One is the third one is the country by country. The first one, as you know, Sergio, is the master file. The second one is the local file. So we have 3 new reports that are required under this legislation in Mexico, and it essentially mirrors the OECD Action 13. So I would say that we're in a very similar forecast. There's a few points that are worth clarifying or emphasizing in Mexico, because our requirements to file under those rules could vary differently depending on the peso exchange rate or euros and other matters. One important matter, Sergio, that comes to mind is the fact that this would be effective for the calendar year 2016, which means that's just 2 months away. So it's something that we really have to keep in mind as we start gearing up towards gathering that information. So I think that is a key point. The other point for the master file and the local file, those both will apply for corporations in Mexico, let's say, that have taxable revenues, and I say taxable from a tax standpoint, revenues of more than 644 million pesos, or under certain other conditions that we mentioned in the slides that the audience has. In the case of the country-by-country report, it's really interesting, Sergio. It'd be interesting to hear what you think about this. The rule mirrors pretty much what the OECD Action Point 13 says, that in this case it really applies when you are the country, the headquarters, so to speak, the parent company, and if you have more than 12 million of accounting revenues as opposed to tax revenues, which is the first part. The extra rule that there is some concern by taxpayers says that in the case that the tax authorities cannot obtain, if you're the subsidiary in Mexico, and the tax authorities cannot obtain that country-by-country report through exchange of information and other sources in other countries, they can request it locally, and upon requesting it locally, you have 120 days to provide that. So indirectly or backdoor, they can require you to provide the country-by-country information even though you're not the parent. So I'm not saying this is inconsistent with what the Action Point 13 is. It could be a clarification. What is your immediate reaction to that, Sergio?
Yes, Fred. In general terms, this action was inviting the countries to redesign their transfer pricing requirements. When this action started, it was clear that the local file, as you mentioned, was going to be there, because currently almost every OECD country has a local file TP documentation requirement. When they designed this country-by-country report, I guess that the idea was to get as much information as possible. But as you say, when a multinational company that has a subsidiary in Mexico is not providing or is not willing to provide to its local authority the country-by-country report, for us it was very surprising to see in the Mexican tax reform that there is a specific requirement for the Mexican subsidiary to produce this report or to deliver this report to the Mexican tax authority. And what is our main concern is this extraterritorial concept. Whenever you are requesting from a Mexican company information that is not her information. So I think this is going to give some space for discussion with the tax authorities in the future. And also it's going to have to be framed in the EOI agreement between the tax authorities, because we find it difficult for a multinational company not providing this documentation to its local tax authority.
Thank you, Sergio. You'll also see in the presentation that we've given to you that there are certain sanctions for non-compliance. There are monetary sanctions, and there is including a sanction that would give you a denial to be a survivor to the public sector. So you couldn't be a provider of certain services depending on non-compliance with these requirements, and that's something that you should keep in mind. Now let's give you a teeny bit more information, at least that's under the legislation in Mexico relating to the master file, the local file, and the country-by-country reports. They're essentially exactly like the Action Point 13, but I'll go over that briefly just so that you get a feel for what we have. In the master file, you're going to have the organizational structure, the description of the activities, the intangibles, financial activities, and the financial and tax position of the group. And in addition, the local file is a file that's strictly for that jurisdiction that complies with the transfer pricing requirements. That really isn't too different than what's already happening in Mexico. So the local file, from a practical perspective, is exactly what we're doing, with the differences that now it would be filed. In the current case, those reports are only prepared and kept on hand in case the tax authorities request them. However, through a series of other reports, which I'll get into, they do ask you enough information in certain questionnaires and checklists and forms to make you provide much of the information that goes into the transfer pricing study. So I don't see the local file being a major point of contention. In terms of the country by country, that includes a lot of information. It's really a table, and it's a by country table of a series of information: sales, intercompany, non-intercompany sales, taxes accrued, taxes paid, a number of other questions: how many employees, how many assets, and it starts to sound a lot like a global apportionment schedule. So that's a little concern to some of our clients in Mexico, that they might be trying to move away from the arm's length principle. My question to you is, does this concern you a little bit, that the focus is moving away from the arm's length principle?
In principle, I don't see the OECD moving away from the arm's length principle. Global apportionment was extensively discussed a few years ago and in recent months also, and the conclusion from the OECD was that the arm's length principle remained to be the standard, or the desired standard, for transfer pricing analysis. So I would be, instead of seeing this movement towards the global apportionment system, to see a better functional analysis with functions, assets, and risks properly taking into account, in order to take a good position whenever you try to assess income to a subsidiary in the world.
Thank you, Sergio. So really what we want to focus on is, what does this do to us? What does it mean to us? And really, we have to change our focus, and our focus needs to be sort of a risk analysis, i.e. a sort of mirror approach to how the tax authorities are going to view this. And part of that requires that we need to understand what their role should be with these schedules, with the country by country, the master file, the local file. And so really, it's really clear, at least from the OECD, and this is what we want to make clear from a Mexican standpoint, is that it should not automatically be used to impose any adjustments, i.e. that information should be used truly as a guidance map, or a map to decide whether an audit should be initiated. What are the level of risks that are relating to tax under tax compliance in a particular regime, including Mexico. And so it shouldn't result in an automatic adjustment or a methodology or a tool to say more income goes to one country than another country.
Yeah, that's a very important part, Fred. It is a tool only for analyzing a risk environment or a risky behavior. It is not a tool that should be used to raise an adjustment. It doesn't substitute an audit. It doesn't substitute a proper review conducted by the tax authorities.
Thank you, Sergio. Some of the key points with this, what I'm calling country by country, but it's actually the 3 reports. One of the focus really, and there's a special BEPS action point on substance and transparency. And so one of the key takeaways, I think, in this country by country is that we're in part of our assessment as we prepare to give all of these forms, is that we do an intense analysis to ensure that the substance behind our companies, our activities, our people, our assets, the risks, that they're all in line with the arm's length principle, and that there is harmony, or at least reconciliation of differences in methodologies and profitability of the countries. So economic substance is going to be a key aspect that I think that we need to focus on as we prepare ourselves for providing these 3 new forms. In the case of providing the report, if you're the subsidiary, as you mentioned, if you're the subsidiary of a parent providing the country-by-country analysis, there's an issue, and it's a practical issue of extraterritoriality in Mexico in that they won't have that information, so how can they be expected to provide that information? And so we can anticipate there could be some problems from a legal standpoint there that we have to start thinking about and learning how to address those issues, because they're going to be practical issues and not just that we don't want to provide the information. In some countries, they won't even have the requirement to do the master file. So that's something that would give us some concern. And the third most important, which we're finding is an important requirement for clients to keep their costs, their payroll, their efficiency in their tax collection process, tax information collection process within organizations, is to have the right information technology, Sergio, that in many cases they're finding that they just don't have the right resources or they don't have the right information, and that information requires a lot of redoing. So what we're finding is the solution is not just with transfer pricing advisors or international advisors. There's also an element of using the technology people from our organization, from the client's organization, or in fact PricewaterhouseCoopers or other advisors that form part of our team in helping our clients comply with these rules. So what are some of the challenges that we're facing? Really, we're moving from a compliance standpoint to a risk management standpoint, as I mentioned earlier. And the whole idea is that we need to figure out how we're going to get all this information, make sure how it's all coherent, consistent, and harmonical to make sure that the information that we're providing gives the right answers to the right questions. And in Mexico, it's particularly concerning because we have a number of information returns, not just these 3 new requirements. We have the Form 76 for transactions throughout the year. We have our questionnaires. We have our transfer pricing studies. We also have to have a number of other Annex 9 to the statutory tax audit reports or to the tax return. We have a number of requirements, and they all have to be consistently evaluated and ensure that we're giving the right answers to the tax authorities. I don't know if this is an issue that clients have expressed some concern to you.
Yes. In general terms, the first concern when the BEPS project was addressing the documentation issues, as is this action number 13, was the burden of the administrative burden that this would suppose for them. So the OECD said in its original papers that they were going to be very careful when raising new documentation requirements. So in this sense, we perceive this as an additional administrative burden. And considering that we in Mexico have a statutory tax report, the informative return, the DIM number 9, the number 4 also, and with format, the 76 form, I think that some of the information that we are providing now or that we are required to provide might be duplicate information. So we have to be very careful that this duplicate data match, because if there is a discrepancy between those data, this could be misinterpreted by the tax authorities as an inconsistency in our reports.
Thank you. So what are the opportunities? So really, this gives us a number of opportunities for our clients to align their operating systems of their companies and align the information gathering process within the companies, and it allows you to gain more efficiencies with your people and with some of your activities in the tax area. It also helps us improve our global vision. It helps us, if not solidify, at the very least document any differences relating to that global transfer pricing policies that are related to our group. In addition, it helps us develop more flexible transfer pricing models. Where there are different ones, we need to get down and develop a methodology to where they can be adapted and not necessarily have to be the same, but at least documented in the right way. What will definitely be an opportunity, at least from a defense standpoint, is to document the substance of operations. When we say substance, the non-tax business reasons, the real substance behind the companies, the people that are performing those tasks, the decisions that are being made. So this will help us get a strong basis to be able to withstand any scrutiny by the tax authorities, which I think is very important. It will require an analysis of the supply chain, and we found that sometimes analysis of the supply chain come with a number of great solutions from an efficiency standpoint. It may cause you to move things around to different countries and different activities in different countries, but it actually, this whole analysis can help you develop non-tax advantages of how your business operations change so that you can operate more efficiently. In addition, of course, as I mentioned earlier, this will help you develop, it'll help you identify and develop defense strategies, which is an important process. I don't know if you would have any comments on this, or are we fairly in line with
Yes.
what you were analyzing?
Yes, thank you, Fred. I think we are fairly in line. The important part of this is that this project that at first 2 years ago seemed like a theoretical project has already taken place in several countries, and Mexico is one of them. We have a reform that it's actually in place. It was approved this morning. So it's very important for us as advisor for Mexican companies and for multinational companies to focus on the existing rules that Mexico has already implemented. And so the time has come for us to take care of this with proper attention.
Great. Sergio, on behalf of PricewaterhouseCoopers Mexico City, we want to thank you for listening in to our webcast. I want to tell you that transfer pricing area, myself, Sergio, we have 11 partners in the transfer pricing and dispute area. We'd love to help you and assist you in any questions you might have. We think it's a tough journey, but we've traveled it, we're traveling it, and we'd love to be a part of your team. Thank you very much.